we're waiting on a couple more people, but people are joining as we go along. So I think an intro won't do any harm, and then we can hand over to the expert. I think it's the way to go. So that's what we'll do. So thank you. Good morning, everyone. Thank you for joining us. Very welcome to come along. We're hopeful today that we've got David come along. He's going to present to us. We've just been talking earlier, actually. The last physical meetings we did was back in February, March time, just before obviously the world changed more than a little bit. And David was our last presenter. We had standing room only in Reading in the Crown Plaza with 30 odd people listening to David. He had rave reviews. So I'm sure you'll all find it very beneficial today. Just for those who don't know me, my name is Mark Darby. I'm a director of Beaufort Financial. We work alongside companies such as Brooks Macdonald, who David works for, amongst others, and try and make sure that our clients have the best solution for them. Today's presentation is very much regarding going for a different change in life, so rather than accumulation, now moving to retirement and looking to make sure your finances can generate required income for you between the now and the day you move upstairs. And Dave has a number of solutions in order to talk that through. So if you have any questions as you go along, please just type them in the chat box. I'll deal with those as we go along. Hopefully Dave's be about 45 minutes or so is the plan. This is recorded, so we'll make sure you get this across to you afterwards as well. But if you do think of anything, please just put it in the chat box, and I'll hand you over to Dave, who will run you through today's presentation. So over to you. I should say there's no fire exits. Mobile phones can stay on. We're not expecting any fire alarms, so we're going to be fine today. So hopefully you're sitting comfortably in your offices or in your own home. So without further ado, David, I'll pass over to you.
That's great. Thanks very much, Mark, and good morning, everyone. And a big thanks to Beaufort again for allowing Brooks Macdonald to come and speak to a wider audience. At Brooks Macdonald, I lead the distribution actually on our court of protection stroke personal injury investment proposition, not the decumulation one, but I do enjoy presenting on decumulation. Because of the level of focus on client vulnerability in the personal injury court protection space for that proposition, the same focus from the regulators lends itself to looking at decumulation. We're mindful that clients have got different challenges now through retirement in a later life, and we know that there's a great focus in terms of regulators on vulnerability in that space, the ageing population being focused on specifically by the Financial Conduct Authority, as well as vulnerability more broadly. So it makes sense that I do present on this strategy. It's a strategy that I enjoy presenting on. It's a strategy I believe in for the right clients, and it's a strategy which has also been applied in certain circumstances for some injured clients. I'll just start to go through a little bit, but by way of the introduction for this, if you think about what a retirement market looked like, 15 years ago, most people would come towards their retirement in an investment portfolio. With that portfolio, they would look to reduce the level of risk in the portfolio the closer they got to retirement. And often, and I was working for a major life insurer at the time, often it was the case that these clients would buy an annuity with the assets they've accumulated within their pension pots. The situation now, post financial crisis, certainly has drastically changed. Interest rates and annuity rates are so low that often the annuity purchase route can be problematic for a client and won't help them to achieve their targets. At the same time, clients are living for longer in retirement. So perhaps in the past, if you could have achieved a good annuity rate by using your accumulated pension investments to buy an annuity, the annuity income could provide certainly for a good deal of the rest of your life. Now, with the annuity rates being so low, clients need to take more risk, we think, in their investment portfolios, certainly around the point of retirement, where they would normally be reducing the level of risk. They should be increasing the level of risk to give them a longer investment period to meet their objectives. In terms of the agenda here, you can see a number of risks pointed to on the agenda there. We'll look at the longevity risk, which I've just touched on. We'll look at the impact of inflation on investment in the longer term. Even though inflation is low, it remains low. You may have seen in the last couple of weeks that the Fed had alluded to the fact they were prepared in the States to let inflation run above the target of 2%, as long as in the long term they maintain that as a measure. It's interesting comments, and it would be interesting to see given the the increased level of mechanics put in place by central banks at the moment to support markets through the virus, then it'd be interesting to see how those things unfold in the future. In some corners, or albeit limited corners of the market, there are some people who think that we could see big inflation spikes that the governments might struggle to control, given the level of interest rates that are already out there. We don't take that view at the moment. We think the medium-term outlook for inflation is fairly stable. But when clients are coming to retirement, say at, let's just say age 65, clients are coming to retire at age 65, what they need to think about is that they might be investing for a very long period. And if inflation does spike during those periods, and potentially if inflation spikes generally, it also spikes around the paying for things such as care. So these things need to be borne in mind by clients. And we'll just talk about the solution that we've put forward today. We'll look at sequencing risk, portfolio risk. We'll touch on structured products, which are a key part of the way we build our decumulation service. But really, the majority of this presentation, I hope, when it comes across, is more educational than talking about what Brooks Macdonald do. Of course, on occasion, I'll probably dip into what we do, but in terms of how the overall structure works, we're not the only firm offering this, but we believe that the use of structured products for us is a key benefit to our service. Okay, just considering those risks then, obviously we know if we're investing that we have investment risk, the risk that the price of assets is going to rise and fall over time. Most clients are comfortable, all investing clients must be comfortable before having a recommendation taken forward with investment risk. And obviously the financial advisors, like the guys at Beaufort, will use things like cash flow planning to help clients align the level of risk in their portfolio to their investment objectives, making sure that they're not taking too little risk, excuse me, not taking too little risk to make the money last as long as it should, and not taking too great a risk, which is also important. Just touching on longevity, there's a slide in a second looking at aging population. The stats are quite scary, really. I think it's difficult. I think most clients aren't prepared for the length of retirement they might need to fund. And considering older people in retirement is actually something that in the vulnerability research I've done, as a wider piece for Brooks Macdonald, has been focused on by Age UK. Age UK are concerned that people, with the reduction in the number of defined benefit pension schemes out there, final salary guaranteed pensions, a lot of people don't understand what their workplace pension is designed to achieve, and they don't understand the longevity, how long they might need to pay for things in retirement. Age UK outlined 3 groups of effectively people who have significant level of assets, who, according to Age UK, don't need to be as concerned because pretty much whatever the eventuality, whatever happens to them in later life, they'll have assets to fund their needs. At the other end of the scale, there's people who don't have a lot of assets who will rely on the state and local authority provision. In the middle is the key group of risk, and in the middle is probably, for us at Brooks Macdonald, it's our core client bank. It's those people who need to make money work as hard as possible and need to make the right decisions in a retirement to make sure they can fund themselves for a longer retirement and possibly through funding for care as well. More and more people are becoming aware of the costs of care as they're seeing their elderly relatives presented with the challenges of planning in later life. And a big factor around that, as I touched on before, is inflation. Sequencing risk is often the one that the hands go up if we're in a face-to-face meeting. People say, what is that? If we're drawing down from an investment portfolio, we need to make sure we account for taking money out at the right time. And in its simplest form, the decumulation strategy is a short, medium, and long-term investment strategy. Overall, it's a long-term, but we need to account for money that we're going to need in the short term, that we can hold in cash, and money that we'll need in the medium term, so up to 7 or 8 years. For us, that involves the use of maturing structured products so that the longer-term portfolio can take on more risk. The problem with sequencing is if you come to retirement, say, and we're not looking at a decumulation strategy, it's standard investment portfolio, the client comes to retirement, they've agreed they might need to take more risk in retirement to make that portfolio last longer. And then unfortunately, they try to retire in March this year. Just at the point of retirement, when they're going to start drawing an income from the portfolio, it might fall in value by 10, 15, even 20%, maybe more, depending on the level of risk. So the portfolio has been hit hard, and that person at retirement might have needed to take a significant withdrawal from the portfolio. A lot of the spending patterns we see in pension income is around the point of retirement. So if you've seen, even say £1 million portfolio hit with a 20% market hit, and then the client needs to withdraw £100,000 for whatever their needs might be in the very short term, already the portfolio in its ability to provide for the client in the longer term is greatly hampered. If you can leave money invested, as in the accumulation stage, when the markets take a big hit, you can afford to leave that money there to recover and grow back. But if your market takes a big hit and you take a big withdrawal at the same time, it can leave the portfolio in a very difficult place. Working with financial planners, this is why we in this proposition work with people like Beaufort, who are always looking at cash flow modelling for clients to outline these risks. And let me tell you now, looking at a cash flow modeller for that client scenario, £1 million to go, I need £100,000, but I've got a long term to invest is one thing. Considering taking £100,000 after a 20% hit would paint a completely different picture from a cash flow point of view, which is why that's an integral part of the service. Okay, looking at longevity, there's some interesting stats in front of you about those percentage of people in this country expected to survive to age 100 by the year of birth. It's interesting to see that from 1981 to 2026, so roughly, I'm a bit older than that, but roughly from when I was born to a few years going forward from here, there's obviously, you know, a big increase in the number of people that are going to live to 100. And going further into the future, when probably some of us will be around, but probably care less about what's going on, even more so. So the trend is clear. And what it means is that people are going to need to spend more money in later life to cover their needs. There's been often the talk in recent years about the bank of mum and dad, which is obviously a big factor because of, you know, changes in the last 10, 15 years about how, you know, children fund themselves in terms of coming out of university, in terms of paying off any debt, in terms of getting on the property ladder. So the bank of mum and dad, everyone's clear on. But one piece of research I've read recently points to the need to think about the bank of son and daughter for those people in later life who have not got the assets to fund the level of care that they're comfortable with. And it's a very difficult conversation. One of the objectives that the decumulation service has been used for at the moment is to pay for clients' care fees. It's all very dependent on the client's circumstances and those circumstances, the wider family, obviously, because we're talking about paying for care needs up to the point of death. And also then we're talking about intergenerational planning. So perhaps maintaining a level of risk in the portfolio is suitable for a wider group of needs and objectives than just the person. For some clients, taking additional risks to pay for care is not suitable, but for some clients, depending on their attitude to risk and the size of their assets, it can be, and it can be a very successful strategy. Just considering, well, we've got this slide up, there's some data I look at quite regularly on vulnerability and aging in clients that points to the number of people aged over 65 in the UK. I'm not slide in front of us, but the number of people aged 65 in the UK about 3 years ago, 1 million people. And if we project forward to about 10, 15 years from now, that number is going to be about 15 million people. So based on the 9 million, you know, it's a 2/3 increase on that number to get us to 15 million people. Most of you, or many of you might be aware, that presents society with a wide range of issues, you know, increased instances of illness, dementia, for example, mental capacity, all things to consider for clients who are investing and for the people that are working and supporting them. You know, there's a lot of people out there. It's great to see there's been a huge uptick in the use of power of attorney in the UK. It's sad to see that the increase in fraud has followed that line. I think some of that and some of the financial abuse or misuse of assets might be down to poor education and lack of understanding by attorneys of what their responsibilities are. And in other cases, it's just blatant financial abuse. But what we're seeing is as the ageing demographic hits our client banks, we've got a greater need perhaps to consider referrals between one another. And I think for me, looking at this, particularly for law firms and financial advisors, I can't remember in the past 20 odd years in a career, a time where a regular and reciprocal referrals arrangement would not be more appropriate. I think there's a lot of advice people need in later life, a lot of things they need to consider. And sometimes I think everyone's guilty of making a referral, but in both directions, when there's a particular point of need. Where sometimes it's just worth talking to our clients about, you know, when was the last time you sat down with a lawyer and discussed your financial future, and vice versa from the law firm, when was the last time you sat with your financial advisor? Because I think a lot of people would love to see a report that could help them understand the potential costs that they might be hit with in later life. When considering paying for care, actually, another statistic is that I think 1 in 10 people in the UK will pay over, or currently pay over £100,000 for care in later life. But unfortunately, only 1 in 4 people actually plan for any care costs within their retirement planning. I know that speaking with financial advisors, such as the guys at Beaufort, is coming into conversations more and more because clients need to understand that, and that's only right. But I think until we see any real change, there's a number of things that need to be accounted for around how social care is provided in the UK. Obviously, there's a green paper on social care that was out there. Brexit was standing in the way of it probably a year or 18 months ago. Now COVID and Brexit are standing in the way of it. But I'd hope to see prospective governments thinking very carefully about funding for the NHS and for social care, and hopefully sorting that out once and for all. So we've got a more level playing field that people can understand how they're going to fund care in later life. Okay, we've mentioned inflation risk a couple of times already, but this is an interesting chart to consider from a cash flow perspective. This chart is derived from a cash flow projection tool similar to the ones that the advisors at Beaufort will use. Very straightforward. We've got £1 million pension pot starting on the left-hand side on the y-axis, and we're just seeing how withdrawals will affect that portfolio over time from age 55 through to age 85. So we can see in the kind of pink shaded line that does better than the blue and then the red lines. In one projection, if we don't account for inflation and we're drawing 5% and we've got 4% growth over that 30-year period, at the end of the period at 85, we've still got a healthy investment portfolio, a very healthy investment portfolio. However, the slide is just there to point out the difference inflation can make over time, and the difference inflation can make can be quite shocking, really. And we can see here, if we just add, when we look at the blue lines and going into the deficit in red, when we add 2% inflation, just 2% inflation into this picture, the client is painted with a very different picture when they come to late 70s and early 80s. And it'll be no surprise to the audience, obviously, that that's particularly the point when assets might need to be there to start covering an increased level of costs, perhaps associated to care. So it's just to point out the level of inflation risk that exists in portfolios. So in order to offset these risks, investment risk is we need to accept if we're going to invest in the first place, but to offset the longevity, the inflation, the combination of longevity and inflation, we need to increase portfolio risk. The problem with that is that increases the risk of getting the sequencing wrong, or taking too much money out of a portfolio, perhaps when the portfolio has been under pressure from market conditions. This is quite a busy slide, but all it's trying to say is that actually we at Brooks Macdonald and the research that we hold believe that for some clients, actually, if there's an increased appetite for risk, especially if you've got a longer period of investment post-retirement. So like I say, in the past, clients would annuitize, or clients might not live as long in retirement. These days, if clients are facing a 20 or 30-year retirement, they might want to think about taking more risk in their portfolio, certainly in the early years, to allow the portfolio a better chance of hitting their objectives throughout retirement and later life. What we're showing here is the likelihood of failure for portfolios with different equity allocations. And again, we've used 5% withdrawals over 30 years. The white bar, as it says, represents the level of equity in a portfolio, and the percentage point at the top talks about the level of the likelihood of failure. And it's fairly straightforward to see that on the left-hand side, if you've got a low-risk portfolio with less than 30% in equity in it, there's a 62% chance that that portfolio will not meet objectives throughout the investment time frame. As we go across and we increase the level of equity into the portfolio, we see at the far end, if we've got a portfolio with 95 to 100% of equities in it, the chance of failure, according to historic data, is much lower at just 27%. Still a chance of failure, but much lower. Now, in this example, we've sort of accounted for costs as well. So it could be that this particular client has a 4% withdrawal or income need, but pay 1% in charges. So charges need to be accounted for as well. Okay. So obviously, as the risk and allocation to equity increases, we can see the chance of failure decrease. But as the point says, as portfolio risk increases, to give us that longer curve, that better investment performance potentially in the longer term, the sequencing risk increases. Okay, this chart, bear with me the data, I'll just explain it sort of quite gently. So on the y-axis, on the vertical axis, we've got the level of return. On the bottom, we've got the number of years a portfolio is invested. What we're looking at here is annualized investment returns, back tested over a long period of time. At Brooks Macdonald, we use something called the Barclays Capital Equity Gilt Study, which goes back to, I think, around 1900, and looks at asset performance over each year and projects performance for the forthcoming years and talks about the outlook. We take our current asset allocations. So with this one, we've got a low to medium risk profile. which would involve maybe about 50% of equity, maybe about 30 or 40% in fixed income, so government bonds or corporate bonds, and perhaps another 10% in alternative assets and cash. And the alternative assets would include the structured products I mentioned earlier. The annualized returns, so the upper green line, the red line in the middle, and the lower green line, is the kind of almost the average returns that we'd expect over a period of investment. But what we're saying in year one is, before we annualize anything, in the period of data we're looking at here, which is over 100 years, if you'd invested at the worst possible time in a low to medium risk portfolio, right at the top of the market, and followed it down in 1 year, you'd have seen a reduction in the portfolio of 11.5%. If, on the other hand, you'd invested at the best time, so perhaps that was, you know, towards the end of March this year, go right at the bottom of the market and follow it up over a period of the year, you could have had a return of 35, nearly 36%. Obviously, investing is a medium to long-term commitment, so we wouldn't expect anyone to invest for 1 year, but we're just showing how that range of returns over 1 year can be quite wide, so there's a lot of volatility to be accounted for. Just focusing on the blue line at the bottom now, this is the worst set of outcomes that any investor could have gone through. So what we're saying here is, even if you'd gone through the worst set of outcomes over this period of investment over 20 years, when you get to about year 7 or 8 on the horizontal axis, you can see that range of outcomes, even the worst possible range of outcomes, becomes positive. So it crosses the line of 0%, okay, on the chart. And over the 30-year period, even with the worst set of outcomes, the average return could be about 2.5%. The red line is interesting. The red line shows what the sort of medium return would have been on a low to medium risk portfolio, and that's about 6.5%. Well, that's before any investment costs come off. That's before any inflation comes off. So if we take, you know, investment costs at somewhere between 1 and 2% as a total, and inflation at 2%, we come down from a return of 6.5% down to a return of about 2.5%, which perhaps won't be enough growth in a portfolio to allow a client to hit their long-term objectives. When we switch to a medium to high risk profile, as I said before, if we can see the data says you've got a better chance of hitting your objectives if you've got more equity in the portfolio, and bear in mind, if people are living for longer, they can afford the time frame to allow the portfolios to fluctuate. Okay, they can see the peaks and the troughs as long as they're not withdrawing at the wrong time. So this portfolio shows, if we're suggesting someone invest instead of at low to medium, so more what you would consider a traditional kind of retirement portfolio, if you invest in the medium to high portfolio, what you've got to watch is, in that first year, if you go in at the wrong time and take the worst set of outcomes, in that 1 year you could have seen a 20% loss in a portfolio. On the upside, you could have seen 43%, but we're going to focus on the risk. So you could have seen a 20% loss. And as I said earlier, in that first year, that could be just the point when large withdrawals are going to be made from the portfolio. So the loss compounded by the withdrawals can put the portfolio under great pressure for the future. What we see again in the blue line being the worst set of averaged outcomes for this back test, is that around year 6, the worst set of outcomes become positive. And that's because equities, as you'll know, and probably we've just been through a period where you've seen plenty of it on the news anyway, if not beyond in client portfolios or with advisors, we've seen quite a sharp recovery. We've seen a sharp recovery in the UK, but not as much as the US. US stock markets are pretty much at levels they were before the virus and the economic effects of that. But in the UK, we've recovered probably about half or slightly more than half of the value of the FTSE 100. But the volatility of equities can be our friend. Most people know that the worst thing to do when equity falls in value is to sell and move to cash. If you stay invested, the history shows that the markets do bounce back, which is why in this higher risk portfolio, this higher risk scenario, the time it takes for the blue line to come into positive territory or to go above the zero return is about 6 or 7 years. So it's actually slightly less than that for a low to medium. But the problem is, if you invest your whole portfolio in this medium to high risk portfolio here, you've got nothing in cash for the early years or nothing in structured products for the medium term, and you're taking withdrawals out in year 1, you can be in a very difficult position. So the returns work out from a longer term return perspective. So the red line here shows the average back-tested returns here of about 8.5%, just over. 8.5% is a much more realistic return that's going to help a client achieve their longer-term objectives in retirement. Medium to high-risk portfolios need clients to understand the level of risk involved. They need a certain time frame of investment. But what we're seeing is the data is showing the longevity is there, and there's a risk of clients not taking enough risk in their portfolios to achieve those objectives. Looking again at that red line, the return of 8.6%, if we take off 2% for inflation and 2% for, as a maximum for investment and advice costs, that's still 4.5%, which gives a much better chance with compound growth of achieving the long-term returns. This chart is quite busy, but I'll just break it down. It's just showing the sequencing risk come to life in a cash flow scenario. And it's looking at accumulation, so growing in investment on the way up to retirement on the left-hand side, and then in decumulation on the right-hand side. In both scenarios, we've got a starting value for the portfolio of 100,000. And we're assuming, obviously, on the left-hand side, no withdrawals, and we're assuming an average return of 6% a year. So what we can see is on the left-hand side, when we're accumulating, the green or sort of blue line shows we have good performance at the outset, as opposed to the sort of purple line with poor performance at the outset. But over time, because we're not taking any withdrawals from the portfolio, the outcomes in the end over the 35-year period can be very similar. It makes a massive difference if you take that scenario and move it into the retirement, the decumulation phase. If clients are taking assets from a portfolio when markets have fallen in value, it causes the portfolio to be under great pressure to perform. And if you're taking regular payments from an investment portfolio during these periods, we often refer to it in the industry as pound cost ravaging. Every time you're taking money out, it's just hitting the portfolio harder and harder, and it's not allowing that portfolio the chance to recover and grow again. And the difference from that is just like we've used throughout this, about a 5% withdrawal. It makes a huge difference to the end outcome, to the client. So the question is, what can we do to get around this, really? Just focusing on that sequencing risk again, this is kind of a summary of the different risks that are involved as a client goes through the journey from pre-retirement through to retirement, perhaps to the right-hand side into later life, where we hit that longevity risk. On the left-hand side, in pre-retirement, we're aware of inflation risk. We've got to pay for things in the future. We need to account for it. We've got market risk. We're taking that risk because we want to get ahead of inflation. We want to meet those future objectives. In the transition phase, so this purple phase, is when the portfolio value is probably going to be at its highest. It's at the point when we're arriving at retirement. Well, that's when the sequencing risk, as I've kind of pointed to it previously in the presentation, sequencing risk is at its highest point. The portfolio is at its highest point, say it's £1 million, like I said before, then you hit COVID or another market event which reduces the value of the portfolio, plus you're taking large withdrawals, it can have a huge effect. And that goes on, obviously, into later life. You've still got market risk to account for, you've still got inflation and longevity risk, but if you get the sequencing wrong, there's a risk that you won't be able to account for those needs now. So we need a solution to find a way through. And the data points to the fact that actually taking more risk when you've got the time frame to do it, taking more risk in a portfolio is more suitable perhaps than taking less risk. I think, I've largely worked in business development throughout the 20 odd years I've been in financial services. Before coming to Brooks Macdonald, where I arrived 3 years ago, I did work as a financial advisor for 5 years for a firm that recommends personal injury investments for clients. Some clients are never going to be high risk. Some clients might never need to take a higher level of risk than low to medium, but others might do. And some clients, if we focus on clients in retirement, looking at the prospective issues they might face in later life, would value a conversation that says, look, if we take a low to medium risk portfolio and we draw down the income from the portfolio and we perhaps draw down some capital, that's one way of doing things. But actually, it could be, if we suffer from market events and withdrawals, it could be that the cash flow scenarios say the money will not last to pay for all the things you're going to need to pay for. In order to do that, you need to increase portfolio risk. And I think it's a conversation that clients would really enjoy to have with their advisors, because they're saying, actually, someone's telling me I need to take more risk. They're giving me the science behind it, but the cash flow scenarios are showing me that it's the right thing to do. We can't take risk. We can't go with a client who's a low medium risk investor, get to age 80 and then suddenly start taking more risk with their fund. It can't be done. That's not appropriate, really. What we need to do is start taking the risk earlier. So where clients are approaching retirement, perhaps at a higher level of risk in a portfolio, that, according to the data we have, it could be the most suitable strategy to maintain for those clients well into retirement and even into later life in some cases, because it increases the opportunity for returns in the portfolio. And I think clients in the longer term will thank their advisors for saying, I really appreciated the level of conversation we had. We can look at the low to medium risk scenario, we can consider that, but let's consider it against what would happen if we took a bit more risk. And I know some clients will never move from being a low to medium risk investor, because they'll look at the kind of losses that they might see at a higher level of risk and won't accept them. Other clients will see those losses or those potential gains and say, actually, I do understand that if I don't take enough risk now, I'm going to run out of money in the future. So at Brooks, what we do here is break this thing down into a short-term portfolio and a longer-term portfolio. And like I say, this is the Brooks Macdonald version. Many other providers are looking at similar data from equity returns, similar story about taking more risk to make sure we don't miss out on our objectives in the future. And our solution looks at, cash in the short term, so 2 years to be held in cash in a portfolio, and then the next, 5 years, so years 3 to 7, would be held, or 4 or 5 years, will be held in structured products. And a list of structured products that, like bonds, like a corporate bond or a government gilt, we buy at a certain level, and we have a good understanding, if we hold them to maturity, what the return will be. So we've got not a guarantee, but we've got a very structured return profile for those clients in those periods. Now, what that does is allow us to get to that magic point of year 6 or 7. If you remember the slides we looked at a couple of minutes ago, where the range of returns in both scenarios, low to medium risk and medium to high, year 7 was the kind of the sweet spot where equity returns will have driven portfolios into positive territory, even in the worst set of outcomes. So if we can hold cash and structures up to year 7/8, then we can afford the long-term portfolio, again at a well-diversified basket of assets, but more equity than perhaps in a low-medium portfolio. It gives us that risk that we can take. But because we've got through that 7-year period of volatility and potential losses that would lead to a negative return, we can afford to take that more risk in the longer term. And over time, what we can do with this solution is always look to maintain an element of cash, always look to maintain an element of structured products. And if the higher risk portfolio produces in year 1 and 2, we can take some of the growth and recycle that into cash, into structures, to keep moving this conveyor belt forward. All of the slides up until this one have been very nice to look at. This one isn't nice to look at whatsoever. It has to go in there. Structured products need to be considered. Some people have bad memories of structured products, particularly around the financial crisis, just at a point where complex financial instruments were wreaking havoc across the world. Certain product providers came to market and were selling structured products in the financial advisory market, and it didn't work out well in some cases. At Brooks Macdonald, I'm not going to read the slide, by the way, but feel free to have a good delve through it. I'll touch on some of the points. At Brooks Macdonald, we've been using structured products for a couple of decades now. They're a key part of what we do when we build portfolios. A key difference to the way we do it in terms of versus the way that people were doing it, particularly around the financial crisis, was that we're buying them on an institutional basis. So we're buying them direct from the banks. They're not repackaged in any way. And we can approach the banks that we conduct due diligence on, and we can ask them for specific structures to meet a specific need. In this instance, with the pension decumulation, some people have said in the past, okay, if you hold 2 years in cash, why don't you hold the next few years, so the years 2 through to 7, in bonds? The fact is, with where we are in the world at the moment, bonds, although they involve less risk than structured products, are not providing the level of returns that clients are going to require. So we believe that structured products actually sit somewhere between bonds, corporate bonds, and equities in terms of risk. And that's been borne out in our experience over the years. So the banks that we conduct due diligence on and work with are just only the major banks and the most creditworthy. People like HSBC, JP Morgan, Credit Suisse, just to name 3. We've got really, really stringent restrictions on which banks we'll use. And also we set the parameters of how we build the structures, we set them on very much on the edge of safety. Structured products involve buying into a market at a certain level of index. And then depending on the return of that index over a number of years, perhaps it's a 7-year structure, if the portfolio achieves the pre-prescribed levels of return, then the clients will receive a payout. And say some of the structures we're working with at the moment are paying out annually between 5 and 8% returns. The risk with structures is when you set a structure, when you strike the price of the index for a structure, say the index the FTSE was at 10,000 today. It's not obviously, but if it was at 10,000, we just want to see that the FTSE is at 10,000 or above in 7 years' time, and therefore the annualized returns can be paid out. When we set them, what we do say is that actually there's a lower barrier below which the value of the index must not be below on the day of maturity. At Brooks Macdonald, we set that at 60% of the original index, which is quite harsh compared to how many other people do it. So we're saying that on the final day, if the market started out at 10,000 points, if it was below 6,000 points, then there's a risk that the client wouldn't achieve the return, that the structure outlined, that the structure would be broken, and what the client would get back would be the return of the index itself. So there is the risk. The risk does exist. Throughout COVID and the market returns is probably a good case study. It's not in this presentation, but no clients that are in our decumulation service saw any of their structured products breach their barriers, because those barriers are set 40% below the opening price of the index. And in the nearest to maturity of those structures will mature early in 2021. That one had a barrier in it for the FTSE of 4,500. So the FTSE went as low as, well, it went just below 5,000 towards the end of March. So it would have had to have fallen another 10% from that point to have breached the structure's barrier. But importantly, even if it had done, obviously the structure doesn't mature until early next year. So there's time for the price to recover, and those clients will achieve the payout that they saw from the structure. So there is risk involved. But for Brooks Macdonald, it's always worked for us, and we've found that managing client portfolios with structures within them allows us to control tax in some ways, because you can align them to capital or to income tax. But also it just allows us to manage a broader diversification within the portfolio, which does work for us over time. I think I've probably covered this slide already on the previous ones, but I'll just talk through again. Again, returns on the left-hand side, number of years on the bottom, back-tested data. What we're looking at here is this shaded area. This is getting through from years 1 to 7. If the client is happy to say, I understand that the more equity I own, the higher my chances of achieving my returns in the long term, and they agree with that, which is fine, the data supports it, then we've got to get to year 7. And obviously at that point, the range of returns has massively narrowed from the best case scenario to the worst case scenario. And even in the worst case scenario, we've got positive territory. And again, the key thing to focus on here is if we invest at that medium to high level of risk instead of the low to medium, for example, we've got that chance of tapping into a higher level of return. So 8.5%, which is a much healthier return, just elevating us above that risk of cost and inflation, just driving down the value of the portfolio. Just to look at a quick example to bring this to life, perhaps, we'll consider this kind of brief story here. Here we've got a management consultant, a lady aged 62 years old, who has £800,000 in a self-invested personal pension. Unsurprisingly, the early years of retirement brings with it greater expenditure, so we're planning for £50,000 per annum income for the next 5 years, and then after that we're looking at about £35,000 per annum. And this is a live scenario created with someone from our Cardiff office with the financial advisor they were working with. The advisor wanted to consider that we factor in the state pension from age 65. So we'll just see how this one plays out. Again, we've got this colourful wheel in the top right-hand corner. We're saying that we need to keep the short-term portfolio in cash and structured products in the sort of gold shaded area. And then we've got this diversified portfolio for the longer term. Just looking at the bar chart on the bottom left, and remembering that this lady specified she needed £50,000 a year for the first 2 years. If I just jump back, sorry, for the next 5 years, £50,000 for the next 5 years. The dark blue bars here, you can see from years 1 to 5. In years 1 and 2, very straightforward. We've got the dark blue bar at £50,000 and we've got the light blue bar at £50,000. That's because in those 2 years, we're going to keep that money in cash and it's going to be in the bank. We're not going to factor in any interest or any growth. We're just going to say that money is banked and will achieve your objective for 2 years. Then in years 3, 4 and 5, we've got what we start to get into a range of structured products that we can invest into. The dark bar is the need. So now we've got the state pension has kicked in. So the dark blue bar has reduced from 50,000 to 42,000. That's the income that this portfolio needs to deliver to the client. And the reason that the light blue bars are a bit lower is we can use structures, and we're assuming a level of growth from the structures, the level of growth that will be specified as they are as we buy them from the market. And the shorter you buy the structures for, so the 3-year structure, you have to put a little bit more into than you do the structure for year 4 and 5 and so on, because the investment growth will make up the difference. Then when we move to years 6 and 7, we've got a lower income requirement because at that point the spending or the travel from the early years is gone, and we've got a lower income requirement. Again, the blue bars and then denoted by the structures that can support that. And all the time that leaves the longer portfolio to get across that hurdle, that 7-year hurdle where the volatility could take the returns up and down. We want to bring it to the point where even in the worst set of outcomes, the range of returns is positive. So just in summary, really, we're looking at investment risk, obviously, as an investment house, and the reason that people, independent advisors like Beaufort, refer to us is from the strength in depth research, analysis, and monitoring that we do on a daily basis. We've got to get across this longevity risk, and I always combine the longevity and inflation risks together. The longer you're investing, the more inflation is going to have an effect. Looking at clients that I've advised in the past, and that we in the personal injury court protection proposition at Brooks Macdonald we deal with now, it's obviously a huge factor. It always comes into consideration. If I'm honest, there's an element where the decumulation strategy has been used for personal injury clients, clients who've lost mental capacity following injury under the court protection service. Some clients are invested in that and have taken on the idea that actually, if I'm investing not just for 30 years in retirement, but perhaps for 60 years, depending on the age of the claimant and the period of investment, taking more risk in the early years can be the right thing to do to make sure, absolutely sure, that all things are accounted for in the future. Having said that, changes in the way that the awards are calculated have changed. The discount rate has caused awards to go upwards in value. So quite often when looking at cash flow, those clients aren't needing to take a higher level of risk. But some have, and some have taken it on because they think, I'd rather take the risk in the early years because I've got a longer time to recover in that investment portfolio, so it's acceptable. Again, the sequencing risk we've covered, it's that first 0 to 7 years, cash in the bank, short-term, medium-term, long-term investment. I think when I did my training as an advisor, it was the fridge, the freezer, and the larder. That was the short, medium, long-term way of thinking of things. But it's very simple in that respect, but it can deliver a very different outcome for clients who need to eke out every return that they might need. And just in a summary, obviously we've touched on decumulation investors, completely different investment risks are present to them than accumulation investors. If you're accumulating, you can see things recover. If you don't need to draw that income out, when you're taking money out, you need to be really mindful of the structure of taking that income and the ability to take more risk in a portfolio to give it that longer investment period to match objectives is critical, but we've got to have that short and medium term accounted for. The cash flow modelling is crucial. We only offer this service as a discretionary fund manager through independent financial advisors. Obviously, a big part of what we do when we set one of these decumulation structures in place is to consider the IFAs and the client's needs from the cash flow modelling point of view, so we can set the right amount of assets into cash and into the structured products for those short to medium term years. And again, as it says, splitting into that short and long term just reduces the chance of failure to meet income requirements in the longer term. And this is the bit that struck me when I first looked at this one and thinking, okay, some clients don't like to be talked up in terms of risk. That's true. But also clients don't like to run out of money. And if they get further into the retirement, you get to a point where taking more risk is not suitable because the time frame to see the investments grow enough won't be there. So these conversations, I think, need to take place prior to retirement, if not early into retirement. And just on one point, we're talking about retirement quite a bit. I know I've touched on injured clients investing in this service, but it doesn't have to be purely a pension strategy. Many clients that we come across have investments of all different types. They've got them in general investment accounts and taxable accounts. They've got pensions, which obviously have tax breaks. They've also got ISAs. So obviously there's a different way to structure this. And again, the investment managers at Brooks Macdonald, working with the financial advisors and sometimes with lawyers that are making referrals of clients, help to set these structures that are appropriate for everybody. And I think apart from a risk warning page, that is it from me. I hope you've enjoyed listening to that. If any of you would like more detail on it and to see a proposal, we're more than happy to provide one via Beaufort. And all that said, I'll stop and see if there's any questions.
Thanks, Dave. That's fantastic. Really, really good. Really, really helpful. Thank you very much. Yeah, as David says, anyone got any questions? If you'd like to add them to the chat box, that'd be fantastic. I've just got a couple, Dave. That's all right.
Yeah.
There's been speculation recently about potentially negative interest rates, which I think is kind of highlighted over the weekend. Just wonder what impact that has in terms of generating income, and if you see kind of alternatives to cash going forward. Is that the structured kind of fits in, I guess, is the question. Yeah,
I think it's going back. Interest rates negative, annuity, or with no real prospect of getting anywhere, any improvement there. And we at Brooks, we're mindful of interest rates. We're mindful of the interest rates payable on gilts, government bonds, which are just not there. In portfolios, we've got a level of gilts, we've got a level of sovereign debt, mainly UK and US debt, because of the level of protection it provides, but it's not paying much out in terms of income at the moment, as you'll know. We're preferring to see equity. Equity is the place to go if you want the dividend income, and at the same time, the structures can provide that bridge between the bonds and the equities. So yeah, cash is low. Cash for us, it's useful as to keep your powder dry in a portfolio, because there will be opportunities presented by the current markets, which is fine. But cash very much for short-term objectives, years 1 and 2 as a maximum.
Great stuff. Okay, that's great. Thank you. I can see